Hello and welcome. This is Business Incorporated coming to you live from our Lagos studios. Thank you for joining us. I'm Chimeze Obi Iwago. On the show today, Zimbabwe's biggest platinum miner says local listing won't work. Sudan plans to cook worth $1 billion this year. Plus, Kenya to set up mortgage refinancing company to meet housing demand. We start off the program with the markets, and positive sentiment trailed two African markets at intraday. Both the South African JSE and the Nigerian Stock Index were up 0.24%. Egypt is closed but was down 0.57% on Thursday. Nairobi closed up 1.38% also on Thursday. In the Middle East, markets are closed today. However, most of them were mainly in positive territory on Thursday, with Saudi Arabia's index continuing to rebound after several days of profit-taking. The Saudi index was up 1.04%, with United International Transportation Company up 2.2%, and loss-making Saudi Arabian home furnishing makers Aus Rael trading climbing 2.2%. The Abu Dhabi index also gained 1.73%, with Abu Dhabi National Energy Corporation climbing 2.4%, taking its surge since March 13 to 11.5%. The Qatari index was 0.98% higher. Commercial Bank was the largest gainer, climbing by 3.4%. However, Dubai's index slipped 0.25%, with Emirates NBD, Dubai's largest bank, falling 3.3%. In Europe, markets were lower on Friday morning as an escalating trade standoff between the world's biggest economies rattled investors. Let's bring in Ulrich Bartz now for details. Hello, Ulrich. Good afternoon.
Good afternoon to you.
Now, how would you describe this flip-flop move by the U.S. President Donald Trump? First, the U.S. had indicated reaching a compromise with China on the tariff issues, and now, late on Thursday, President Trump is considering $100 billion of additional tariffs on Chinese goods. When will this trade war end?
Yeah, it's impossible to say. It was such a surprise to the market today. People I talked to weren't reckoning with this, that it would indeed go like a ping pong ball back and forth, and that the ping pong ball would continue getting bigger. It's now 100 billion. Before it was 50 billion. The first round was around 3 billion. And this does not augur well. I don't think anyone can say when it will end. The Chinese are adamant that they are right, and the U.S. president, everyone knows, he's been saying this since he campaigned. He's staying true to himself that his first priority is U.S. business, U.S. industry. He doesn't believe in the benefits of globalization or negotiated rule-based trade, as long as it at least is to the detriment of the United States. And from his point of view, he does have an argument with the recent trade deficit in February going up by a lot, by $900 million US, and that put the trade deficit in the month of February at the highest it's been since the year 2008. So he sees that he has a point. People in Europe here are worried. The markets are okay. The DAX is going down a little bit, as are other important indices. If you look at Paris or London or Milan, markets are going down, but they're not tanking. People are waiting what continues to develop. But an ECB official is worried. He said in a speech today, Benoit Cœuré, he's a board member, very important person there, that he sees world GDP decreasing by 1% in the first year after tariffs initiated in a trade war by Donald Trump with trading partners. But he sees the worst effects for the United States itself, with GDP going down by 2.5% within the first year after tariffs.
Now, investors are also looking ahead to the U.S. jobs report. The numbers should be out by now. What do they say?
The numbers are out, and they're surprisingly subdued, a little bit like the market reaction to Donald Trump. The number of new jobs created are much less than people were forecasting. There was a forecast that there would be 190,000 new jobs in March. In fact, the number is almost half. It's 103,000. That's a major difference to the negative. And hourly wages in March did increase by only 0.3%. So for this, the market first reacted positively. If you look behind me on the board in the DAX, you can see the initial reaction was, oh, not so many jobs. Maybe the Fed won't do so many rate hikes. But that quickly changed into a negative reading. Add this to trade conflicts and other issues, and then you have growth prospects that are not so great. That, I think, the initial reaction to the first reading on these numbers.
Sure, I guess the trade war would continue to drive sentiment for some time. Anyway, lead us into market next week. What should we expect?
Well, there's so much on the plate. I don't know where to begin, but I'll begin with the Monday.
We'll begin somewhere.
Xi Jinping, the president of China, is due to speak at a major Asian economic meeting, and it'll give him an opportunity to spell out reforms in the country, but also, of course, an opportunity to speak to the world on his position on the trade conflict with the U.S. One would be surprised if that was not mentioned there. That's a major issue. And at the end of the week, there's going to be the start of earnings seasons, and it's going to be a whopper with three major U.S. banks reporting, J.P. Morgan Chase, Citigroup, Wells Fargo, and there will be the Summit of the Americas with Donald Trump having an opportunity to speak to the public, and he'll surely have to address the trade war. It'll be the Summit of the Americas being held in Peru's capital, Lima. That's a major event next week, and in the middle of the week, it's on Tuesday, in fact, you'll have the minutes of the last FOMC meeting of the Fed. That is the Interest Rate and Monetary Policy Board, the Federal Open Market Committee minutes. And usually they have some sort of surprise that either enthuses the market or depresses the market, depending on how hawkish they are on further interest rate hikes in the United States. And that's, of course, one of the major topics for markets worldwide.
Oh, well, I guess I have quite a lot to chew with Daniel next week. In the meantime, Ulrich, thank you very much.
Well, yeah.
Enjoy the rest of the weekend.